It finally happened. You did it. You moved from home seller to real estate investor. If you decided to rent out your house instead of selling it, then this video is for you. Today, we're going to break down the 3 different rental strategies that you can use to make sure that your rental, instead of selling it, remains profitable. Now, there's a ton of information on each of these 3 strategies, so I don't have enough time in this one video to break down each individual strategy and really dive into the nitty-gritty. So this video is going to be mostly about a high-level overview to give you a general idea of each different strategy, pros and cons of each, and how to implement them. If you just turned your old primary residence into a rental and your rental numbers are looking just a little bit skinny, then this is the video for you. Let's get started. Before we can get too far into this discussion, we got to talk about some basic definitions. And those are the 3 different types of rentals that you can use for your property. Those 3 different types are short-term rentals, medium-term rentals, and long-term rentals. So short-term rental is just going to be something that is 30 days or less. Although typically your normal short-term rental guest is only going to stay for about 3 to 7 days. The midterm rental is the second strategy. A midterm rental is typically anything from 30 days to 6 months. And a lot of times these are travel nurses or traveling construction people, or maybe just a corporate lease that needs a place to home their employees for a little bit. The last strategy is a long-term rental. A long-term rental is exactly what you think of when you think of traditional tenants and rental properties. So this is someone who's going to sign a year lease, maybe longer, maybe just a little bit shorter, but overall, they're going to be in the property for at least a year, maybe more. So now that we've got some basic definitions down and we know what a short-term, medium-term, and long-term rental are, let's do a quick comparison of the 3 different factors that are going to differentiate each one of these strategies. For our comparison of these 3 rental strategies, let's start with the strategy that most people are most familiar with, which is long-term rentals. As we're evaluating these strategies, we're going to look at 3 different factors, and those factors are profitability, headache, and expenses. So let's start with long-term rentals. A traditional, typical long-term rental is going to be low headache, low expense, and also low profitability. The reason a long-term rental doesn't have a ton of profitability, nor does it have a lot of expenses or headache, is because it's kind of a set it and forget it strategy. Once you get the tenant in there, usually the tenant's going to pay all of the utilities. So the only expenses that you have as the landlord are the mortgage payment and maybe an HOA fee, something like that. Now, midterm rental, you might have guessed, is medium headache, medium expense, and medium profitability. This is personally one of my favorite strategies because it kind of blends the profitability of a short-term rental with the lower headache factor of a midterm rental. In this case, you are going to have some higher expenses because typically the landlord is going to be paying utilities, HOA fees, internet, that type of thing. But because the lease is going to be a little bit shorter, anywhere from 30 to 180 days, you can charge a little bit higher price because it's more inconvenient for you. So if long-term rentals are easy and low headache, midterm rentals are kind of easy and kind of a headache, that means that short-term rentals are both expensive, have a high headache factor, but are also the most profitable. The reason that a short-term rental is going to be the most profitable, but also probably have higher expenses and a higher headache factor, is because as a short-term rental host, you're more in the hospitality industry than in the real estate investment industry. For a short-term rental, you're going to have expenses like cleaning fees, utilities, fees from your booking platforms, furnishing costs. I mean, the list goes on and on and on. So the expenses can rack up pretty quickly. Now, on the other hand, because it's a short-term rental and because people are only booking your place for a couple days to maybe a week at a time, you can charge a lot higher prices, particularly because most short-term rentals are already furnished. I mean, think about the last time you went on vacation. You didn't want to go and live or stay for a week in an apartment or a house that has 0 furniture and no TV, nothing like that, right? So as a short-term rental host, you have to think about all the things that you would really enjoy when you were going on vacation and try to provide that experience to your guests as well. If you've been following my channel for a while, then you know by now that I am a real estate nerd and I love numbers. So to break down some of these strategies, we're going to do a quick comparison by running actual numbers from my properties of a short-term rental versus a long-term rental. Let's start with my low headache, low expense, and low profitability duplex, which I have located in Summerville, South Carolina. So the rents for this duplex are a combined total of about $2,155, and the mortgage payment on it is a little over $1,300 at $1,310. So this duplex is also located in an area that does not have an HOA. So the only expense that comes out of my pocket, other than the mortgage, of course, is my property manager, who charges me 9% of my gross monthly rents. So for this discussion, we're talking about $194, which is 9% of that $2,150 total rents. So to get to my net profit number, we take the $2,150 total rents minus the $1,310 mortgage payment minus the $194 property management fee, and that leaves me a net profit of about $646. Now, for some people, they're going to hear that I have a $600 a month profit on a long-term rental, and they're going to think, holy crap, that's phenomenal. And I don't disagree with them, because typically I see long-term rentals making about $100 to $200 per unit or per door. In this case, because I've owned this property for a couple of years, I've managed to raise the rents to keep track with the market pace. So that's why I have a little bit higher profit margin on that long-term rental. Now that we've talked about the long-term rental, let's run the numbers on my short-term rental. This one's going to be a little bit more complicated because there's way more that goes into it than just a mortgage payment and a property management fee. So for my short-term rental in the high season, so that's over the summer, my gross payouts from Airbnb are about $6,500. So at first glance, that $6,500 sounds pretty juicy, right? But here's the thing. The mortgage payment, which includes a very expensive HOA, comes out to about $2,900 a month. Woof, that's like half of my profit right there. On top of that $2,900 a month mortgage payment, I also have typically about 5 stays per month, and each one of those stays incurs $135 of cleaning fees. So if we have 5 stays that are $135 each, that's $675 just to keep the place squeaky clean for my guests. On top of those cleaning fees, I also am paying for all the utilities, which is water, sewer, electricity, and the most important utility, which is internet. Believe me, people do not like it if you don't have internet. It's 2025 after all. And all those utilities come out to be about $205 a month. So if you're keeping track of all the numbers at this point, my short-term rental brings me $6,500 of gross rents minus the $2,900 mortgage payment, minus the $675 cleaning fee, minus the $205 utility fee, which brings me to a net profit of about $2,720. So again, in comparison to my long-term rental, which is already performing pretty well as a long-term rental at $600 a month, that $2,700 a month profit, that's like, holy crap, that sounds huge. But here's something that you don't usually think about with a short-term rental. We're living here in Charleston, which is a great beach town where a lot of people like to vacation in the summer. So what happens in the winter? That's the catch. That's the catch 22. Because in the summer, my gross rents from my Airbnb are super high, which is great. But in the winter, my profits go way down because not as many people want to come to sunny Charleston, South Carolina if the sun isn't out very much. So generally what happens is over the course of the year, my Airbnb more or less breaks even because the high profitability summer months make up for the low profitability winter months. And overall, it just about breaks even. So we're just about wrapping up with our overview of the 3 different rental strategies. But here's a quick last tip that I want to address. Each one of these different strategies is going to be right for a different type of person. For example, if you have a very low risk tolerance, then a long-term rental strategy is going to be perfect for you. It's steady rents over the course of a year. You don't have to worry about tenant turnover. It's pretty much set it and forget it. Now, on the other hand, if you love the thrill of a risk and you want that higher reward that comes with that risk, then a short-term rental is going to be right up your alley. The income is going to vary month to month. You don't really know what your total income is going to be. You can make some projections, but you don't know for sure. And the expenses can pile up pretty quickly. So really, at the end of the day, it's whatever makes you comfortable. For me, I hedge my risk by mixing a combination of my short-term rental and my long-term rentals. So as a whole, the way I've designed my portfolio is my short-term rental gives me those big pops of cash during the summer, but my long-term rental helps me make up for any losses that I might take if I have a particularly slow, low season. So let's do a quick recap of everything we talked about today. First, we talked about the 3 different types of rentals, short, medium, and long-term, and we defined what the average stay length is for each one of those rentals. Next, we talked about the different comparisons between the headache factor, the profitability factor, and how much the expenses are going to be for each one of those strategies. After that, because I'm a nerd, I dove right into the numbers and we talked about exactly how much money I'm making or losing each month based off of my long and short-term rentals. And then to wrap it all up, we talked about which strategy is right for you, which is mostly based off what your risk tolerance is. Like I said at the beginning of the video, this is just a high-level overview of these 3 different rental strategies. So check out my upcoming videos in the next couple weeks, where I'm going to do specific videos to talk about each one of those strategies more in depth. As always, if you think these nerdy real estate topics are interesting, check out my other videos. And if you're looking to get your short-term rental up and running, check the description for a link to my Airbnb referral, and we can help get you set up with your first short-term rental.